Hey everyone, and thanks for jumping back into the cryptoverse. Today we have Michael Saylor on the show. We're going to be discussing Bitcoin primarily. We might touch on some other cryptocurrencies. We're going to be going over general investment strategies, portfolio theory. Michael is the CEO of MicroStrategy. He's been really paving the way for institutions to come into Bitcoin for a long time now. Michael, it's great to have you on the show. I really appreciate you being here.
Yeah, thank you.
I think most people are very familiar with your stance on Bitcoin, but could you give us just maybe like a brief sort of discussion or insight into what you view Bitcoin as and why you're sort of investing in it and why you see it as, the future of monetary policy or something?
You know, I think that the most important point is that this is a technology investment. It's a technology theme. Uh, if you look at the most successful investments of the past 10 years, Facebook started from nothing and it dematerialized human relationships. It was a social network, and that meant that they channeled social energy onto a digital network for a billion plus people, and it's worth $1 trillion today. Apple is a mobile network. What they did is they dematerialized mobile devices. They dematerialized your communications, your cameras, your videos, your documents, and it's worth a couple of $1 trillion. And Google is $1 trillion business because it dematerialized information, information network, search network. So what's the theme with all these things? It's like, I want to give music to 5 billion people. I have to suck the music out of the CD, the record, the phonograph, the Steinway piano, the orchestra. And if I do that, I can give you a catalog of 50 million songs that cost $15 a month for the family plan. And for $3 a month, you can give infinite music to everybody on earth. And if I want to give everybody infinite free education to 5 billion people, I have to suck the information out of the books, out of the libraries, out of MIT, out of Harvard. And I do that with iBooks and YouTube. And so that's digital education. The other is digital music. Bitcoin is digital property. We are sucking the monetary energy out of houses and bars of gold and silver and bonds and stocks and collectibles and anything else that we monetized in the world. And it's, if I have $1 billion and I want to put it in gold money, I have 30,000 pounds of gold. And if I want to move 30,000 pounds of gold from New York to Tokyo, it's $5 million and it takes 3 months. And it's pretty obvious that if you leave all the money in the gold, you can't program it to be 1,000,000 times faster and smarter, and you can't move it at the speed of light. So we have to dematerialize things to make progress in the 21st century. All of the $1 trillion networks all dematerialized something, Google, Apple, Amazon dematerialized every retail storefront. If you basically obliterated every retail store and you put it into software and put it in the palm of 1 billion people's hands, right? I'm not saying they obliterated the stuff they ship, but they obliterated the retail distribution channel. So Bitcoin is digital property. Here's the big idea. I want to give joy to 5 billion people. I give them digital music. I want to give education and information to 5 billion people. I give them digital books and I give them digital video. I want to give wealth to 5 billion people. I give them digital property. The future of the world is 5 billion people. They're already there, right? There's 5 or 6 billion mobile phones running Android or iOS. How do the 6 billion people with mobile phones carry around $387 worth of property for the next 100 years? Right? I can't ship them gold. If I shipped 1 ounce of gold to everybody on earth, that's all the gold. But if you try to take $387 worth of gold per possession, it's a 40% markup. It takes you 6 weeks. If you want to sell it, it's a 30% markdown. You can't program it. You can't carry it on your iPhone. It's illegal to ship it. It's not going to work. Okay, so what's the hope for 5 billion working class people to own property? If I can't hold gold, land, how do you buy $387 worth of land? Good luck with that, right? It's 6 months to buy and sell land. You got a real estate broker. How are you going to break up $387 worth of land in Kansas? And is that the land you want? Or buy $387 worth of land in New York City? Good luck with that. Even if you could buy property as real estate, you've got property tax. So if you own $1 million of property in Florida, it's 2% property tax. In 30 years, you're losing your property. So property taxes and property restrictions and the fact that land is heavy impairs the value of property. Gold is impaired. I famously did a gold debate. It's been seen by 1 million people. I give you 1 million reasons why gold is defective. Mm-hmm. Gold miners keep dumping gold on the market. They inflate the gold supply by 2% a year. 85% of the monetary value of gold is destroyed over the course of 70 to 90 years. And in 95% of the cases, the government or a hostile seizes your gold and kills you, or they just steal the gold. So gold doesn't work. Property doesn't work. So where are you going to store your monetary energy and property? Your next thing is bonds. All bonds have a negative real yield. If you're holding sovereign debt that yields 2% interest and the monetary inflation rate is 7%, over the course of 100 years, your money is zero. Cash, the US dollar lost 99% of its value over 100 years. You can't hold monetary energy in cash. That's the winner. The US dollar is the winner. Every other currency lost more. If you had your money in Zimbabwe or Lebanese or Syrian or Iranian or Argentine or Brazilian or Venezuelan or Russian or Japanese, if you had it in German currency, you lost your money 3 times in the last 100 years. So cash doesn't work. Gold doesn't work. Land doesn't work. Now you're down to equity. Okay, give me a company you can hold for 100 years. Right? Where? Okay, so what's the best equity in the world? Big tech. NASDAQ has performed the best. I made a lot of money. Holding Apple, Amazon, Facebook, Google. They're up by a factor of 10 to 20. Right? On the other hand, Apple's a monopoly. There's an antitrust issue. Google is a monopoly. There are antitrust issues. Facebook has antitrust issues. They've all got the risk of income tax. They've all got employment tax. Amazon wants to be unionized. There's unionization risk. They've all got CEOs. They've all got products. They've all got execution risk. They've all got competitors. So what if I wanted to take all the big tech companies and get rid of the CEO, the board of directors, the product risk, and the tax risk and the employment risk? What would you have left? Bitcoin. Bitcoin is big tech without the company part, without the product risk part. It's just a big tech network. It's more global, and the product is simple. It couldn't be a simpler product. I have a Bitcoin. Well, what's the plan for next year? A Bitcoin. What's the plan for 100 years? A Bitcoin. Right. Well, what if you don't change it? I don't want to change it. You don't want to change it. What is it? It's a creature in cyberspace. It's like plankton. I've created the elemental container to hold monetary energy. What's the goal? To not lose your money. That's the goal. So the value proposition of Bitcoin is it's digital property on an open, decentralized network given to the world. Nobody can control it. No one needs to improve it. It doesn't, all it needs to be is to exist. And if you want a metaphor, like how do I see it? It's like if you could go back 200 years and you could buy Manhattan, all of it, would you? Would it be a good investment? Mm-hmm. When would you sell it? What's the best time? Would you short it? Would you trade it? what's the best time to sell Manhattan if your family owned it in the year 1800? When would you have wanted to sell Manhattan?
Right. The answer is never.
Never. Right. Okay. Now, what do you own? You own a city block. What's great about it? It's on granite. Manhattan is granite. What's good about that? Well, if you actually own sand and you build a building on sand, it might collapse, right? The Surfside tragedy what happens when you build a 100-story building or actually that's 12 stories on a weak foundation. Manhattan is special because it's a great piece of real estate. It's sitting at the Hudson River mouth, so it's geographically well located. It was a shipping center. It's the greatest city in North America. Maybe it's the greatest city in the English-speaking world. New Yorkers think it's the greatest city in the world. Mm-hmm. But it doesn't displace the need for Paris, London, Beijing, Singapore, or Tokyo. So it's just one of 20 great cities in the world. But if you had actually bought 25 city blocks in Manhattan 200 years ago, your family could have held it and it would still be valuable. Now, that's what Bitcoin is. It's buying a block in cyber Manhattan. Might it be good for 100 years? Sure. Might it be good for 1,000 years? Yeah. One day 1 billion people might live there. There's already 150 million people there now. What if 5 billion people lived there? Well, why wouldn't they? Everybody in Japan can't move to Manhattan, but everybody in Japan can own Bitcoin. Why wouldn't you? It's the dominant digital property network in the world. It's the most secure, with the greatest integrity, with the most durability, with the least likelihood of being impaired or broken of any kind of property. So that makes it the apex crypto property. It also makes it the apex property of the human race. There's nothing better. Everything's riskier. Everything is more likely to be impaired. And what do you do on top of a block in Manhattan? You build a building. Okay, so your family can build the Rockefeller Center. Good building. Lasted 90 years. I think, 1932, 1933. 90 years old. Okay, good. Will it last for 1,000 years? No. Will it last another 100 years? Maybe. What do you put in the building? Businesses. Name a business in 1800 in New York that's still here. Name a business that was in the Rockefeller Center that's still around. Some, 5%. Mm-hmm. So what do you have? You can either buy property with a 500-year time frame. You can buy a building, a platform for business with a 50-year time frame or a 100-year time frame. Or you can start a business, which goes in the building. A restaurant, a discotheque, an insurance company, a bank, a brokerage. Okay, so how does that compare to the crypto world? Bitcoin's the cyber property. Ethereum is probably the cyber platform. It's the crypto platform. They want to be a platform for other businesses. Mm-hmm. And then everything running on it, that's the application, and that's the business. The businesses have a much higher risk profile, right? I mean, there's 100 restaurants that come and go. They have lower capital. It's capital intensive to buy how much does it cost you to buy a block of Manhattan right now? Pretty expensive. How much would it cost you to build a building? Less expensive. How much does it cost you to start a restaurant? Not that much. I can rent some space for 2 years and start a restaurant. If you don't have capital and you're trying to actually create something new, you're going the application route. If you have a decent amount of capital, you're going to build a building. It's $1 billion. If you have a lot of capital, you might just buy all the land underneath and wait. They're different business propositions. They're on different frequencies. They have different risk profiles. So that's my view on Bitcoin. I think that the idea of Bitcoin is you're literally buying a city block in cyber Manhattan with the opinion that it's $1 billion of monetary energy. Why do I want it? Because the 21st century economy is going to be built on money. Who can use it? Look, people in Ethereum and smart chains, smart contracts, they can use Bitcoin. They can move it around. You can use Bitcoin to stake Lightning applications. So layer 2 apps like Lightning can use it. You can create your own side chains. They can use it. Square and PayPal can create centralized CeFi applications using Bitcoin. They can use it. Coinbase and Binance can use it. It's pretty obvious. Fidelity can offer funds on Bitcoin. Insurance companies can build Bitcoin into insurance. MicroStrategy built a treasury on top of Bitcoin. MicroStrategy issued equity, converts, and secured debt, which are derivatives of Bitcoin. Okay, would it be interesting for a company to use Bitcoin as part of its treasury? Well, my stock went from $120 to $600 a share, and we made billions and billions of dollars for our shareholders. Doing what? We didn't build a proof of stake network. We didn't even build a Square Cash App network. We just bought billions of dollars of Bitcoin and made billions of dollars. Okay, what's the right application of Bitcoin? I don't know. I don't care, right? I think it's very competitive. So my view on this is Bitcoin is good because it's Apex property. It's Apex digital property. It's the most secure crypto asset in the world, the least likely to be impaired, but it's also the Apex property. If I have $1 billion and my choice is $1 billion of gold, $1 billion of silver, $1 billion of lumber, $1 billion of Apple stock, $1 billion of FANG index, $1 billion worth of land in California, $1 billion building, $1 billion of S&P 500 index, $1 billion worth of sovereign debt, $1 billion of US dollars, or 1 billion euros, or 1 billion yen, or 1 billion fill in the blank, or 1 billion worth of Bitcoin, or 1 billion worth of any other crypto, Bitcoin is, in my opinion, the least risky, most useful thing for the 21st century economy. If your time horizon is 5 years, it's probably a good idea. If it's 10 years, it's a better idea. If it's 100 years, it's a great idea. And if your plan is, I'm just going to buy $1 billion of it and sit on it for a decade, yeah. Do I have to do anything? No. If you owned 25 city blocks in Manhattan, if your family bought 25 blocks of Manhattan in the year 1900, what's your safest business strategy? Hold it. Maybe you would rent it out. Maybe you would give someone a ground lease on it. Maybe you would borrow against it. You know, the richest families in London, if you go to London and you look, they've got a lot of buildings that are sitting on a 100-year ground lease. They don't own the land. The Duke of Wales owns the land. Like last I checked, the royal family owned like a lot of land in downtown London, or the nobles, or whatever. They don't even sell you the land. They just own the land forever. If you really want to be wealthy, what if you just owned, the square mile in the middle of Manhattan or London? And what's your business strategy? Hold it forever. As long as you can generate yield on it via rent, you can pay your bills. And if you don't want to generate yield on it, then you borrow against it. If you have an asset that's high quality, and it's, why does owning land in New York work? Because my family buys I buy $100 million of land. The Fed prints 7% more money a year. The value of the land goes up by at least 7% a year. Eventually, I have $1 billion of land. I eventually remortgage it. I refinance it every year. I'm borrowing money at 3% interest, or 4% interest, or 2% interest. It's going up 7% a year. I'm paying no capital gains tax. I'm paying no income tax. Eventually, 100 years later, my family owns $2 billion worth of land. I've got a $900 million mortgage on it. I put another $100 million on it. I borrow the money. I live off of it. I never sell it. I never do anything. I just live off the assets. That same idea worked with Bitcoin. If the Fed, prints 20% more money, well, Bitcoin's up 275% this year. As long as we keep printing more money, if I can finance the stuff that I'm holding, it will appreciate in value faster than the rate that the currency supply expands. And the arbitrage is obscene. I can borrow money against it at 1, 2, 3, 4% interest. It's appreciating at 20%, 30%, 50% interest. as long as the appreciation is north of the interest rate, you've got an arbitrage. The more assets you have, the better off you have. And so what you really want is you want the most durable, highest integrity property that's least likely to be impaired, that's easiest to improve. And so that's my thesis on Bitcoin, if that helps.
Yeah, I mean, it does. I do want to touch on a few different points. I agree with you. If I had $1 billion and I had to pick one asset to buy, I would buy Bitcoin. I agree with that. I mean, in terms of everything else you mentioned, there's no fixed supply. I've heard your discussion before about why it's thermodynamically sound, obeying the laws of thermodynamics with Bitcoin. But I guess my question for you is, yes, if you only could buy one thing with Bitcoin, or if you could only buy one thing for $1 billion, it would be Bitcoin. But we're not constrained to only buy that one thing. And I'm sure you have, well, I guess I don't know. I'm guessing in your portfolio, you have more than just Bitcoin. Maybe not your crypto portfolio, but I imagine you have exposure to other assets as well. I mean, I know you've done very well investing in equities in the past. How do you manage that, some type of portfolio theory? How do you figure out, what sort of allocation you want towards Bitcoin and or stocks? Now, I would agree with you 100 years ago, if you had bought any business, yeah, I mean, there's a good chance they're not around anymore. But I mean, today you don't have to buy a single business. You could just go buy an index fund or a mutual fund. You're still doing relatively well. And I know the general idea is you can take a loan for 2.5%, and as long as your annual returns are easily beating those, there's no reason not to do it. But I'm also curious. Is there? Sorry, I'm hearing a little bit of an echo. Is there a level of volatility that is okay? So we know with like the S&P 500, there's going to be some volatility, but we know that annually you expect to do pretty well over the long haul, and that's why you could argue taking out a loan could make sense as long as you have the income to make the loan payments. You're applying the same thing to Bitcoin, which has better returns than the S&P 500 annualized. But Ethereum has great returns too. So I guess my question is, are there ways when you look at what you want in your portfolio, are there certain volatility restrictions that you would imply or that you would have to have before you would say, okay, it's worth the risk? And furthermore, how do you sort of figure out what allocation to put towards each asset? Because again, yeah, like if you could only pick one asset, it might be just $1 billion to Bitcoin, but you don't have to just pick one. So how do you figure out how you split that up among various assets?
I think if you want to construct a portfolio, you have to start, let me just start with one observation. This whole idea of, the right thing to do is have a diversified portfolio is in and of itself just a prejudicial bias. It's like it's not even true sometimes. It would be true under certain circumstances, but just allowing people to put that in your head is ridiculous. For example, it might turn, if I knew that everything was going to zero except for one thing, if I knew that, right, then it doesn't make sense to have a diversified portfolio. And you have to actually think more deeply about the macroeconomics here. And the macroeconomics and the political and the social economic dynamics would determine what is your state space of potential choices. You're on the Titanic is sinking, you're going to die, and there's one lifeboat, and you've got 10 people in your family. Okay, do you actually put one person in the lifeboat and the other 9 stay on the Titanic? Or do you all get on the lifeboat? Because you're going to die if you stay on the Titanic. Everything is sinking, right? I mean, you're on an airplane and we blow out the window and oxygen is coming out of the cabin, an oxygen mask drop down from above. Does everybody put on the oxygen mask, or does just one person or 2 people or 10% of the people put on the oxygen mask? If you're in a life or death situation, portfolio theory is ridiculous. And if you're an engineering situation, if you're building a building and you have a portfolio of clay and bricks and aluminum and brass and copper and steel, and you can choose anything to build the building with, diversifying and using some clay and some copper and some steel is not the right answer. There is a right answer under an engineering constraint. You build a plane in aluminum, you build a building with steel. When we didn't have steel, we had iron, and before iron, we had masonry, and the buildings were 6 floors high. And when there's a new technology which is better, it completely invalidates the previous science. So let's look at portfolio theory. Well, you know, there's a lot of arrogant presumption in portfolio theory. Like, if I put you, let's take this example. If you were in Lebanon and the pound is 1,500 pound to the dollar, and if I were to tell you that the currency is going to crash, you're going to lose 85% of your value in every locally denominated currency and currency derivative. And your choice is a market basket of Lebanese stocks, Lebanese real estate, Lebanese currency, Lebanese bonds, you know, or Lebanese savings accounts, or the US dollar. So what's your portfolio theory tell you? Like, tell me what your diversification strategy is. Should you diversify? Because every single thing other than the dollar is going to go to minus 80% next week. No diversification makes sense. They're all correlated to the currency. And so you think you're diversified, but the real question is, like, let me put you in a different situation. You're in Germany, right? And the Nazis are about to take over, or you're in Germany and they're about to lose the war. Okay, tell me what your diversification strategy is across all German real estate, bonds, stocks, or whatever. If the government fails, or if you're Jewish and you're about to get thrown into a concentration camp, the overarching issue is everything you can invest in is correlated to the political situation. In Russia, you know, when the communists take over, they're going to seize all the private property. So having a diversified portfolio strategy of properties that are about to be seized by the government is a waste of your effort. So the real question is this portfolio of things correlated? Because most of these things, like for example, today, every stock is a currency derivative. Every stock is valued based upon the expected cash flows of mostly US dollars and to a smaller extent euros. And every bond is a currency derivative. And and all the derivatives are currency derivatives. And all the commercial real estate is a currency derivative. And all the ETFs are currency derivatives. So, and all the currency obviously is currency derivatives. So 90% of what people think they're diversifying into is all correlated to the US dollar. And the US dollar was devalued by something on the range of 30 to 40% in the last 12 months. If we look at performance over the last 12 months, S&P is up 39%. The S&P generally is up 10% a year for 100 years. So 39% means a 29% collapse. Plus, the dollar was already being devalued at 7% a year. So you could say that backing out the risk premium of holding the stocks, which is traditionally 3% a year, you had a 36% devaluation of the US dollar in the past 12 months. Which meant that was a 36% devaluation of all value stocks, all cash, all bonds. If you're holding a bond that's yielding 4%, you've got a negative real yield of minus 34% in 1 year. So to be extreme, what's your diversification strategy if you're holding Argentine equity and debt and real estate? Because the inflation rate there is 85% informally right now. So when you say, should we diversify? The answer is, let's come back to Lebanon. The only answer is you had to convert to dollars, but that didn't work either because they seized all the dollars in the banks. Like they froze all the accounts. So it only works if you diversify to a hard asset and then you get it out of the political jurisdiction where it might be impaired. So we come back to your question, like, how do I view the world today? I think that the first issue is the currency is being devalued everywhere in the world. It's being devalued at the rate of 20% or more, at least in the US. Every other currency is pegged to the US currency. If the U.S. currency actually just collapsed 37%, which is what the S&P index is pointing to, that means the euro collapsed 37% against scarce assets. That means the Chinese yuan collapsed, the CNY collapsed 37% because it's pegged. That means that the Saudi currency, the Emirati currency, the Swiss currency, the Singaporean currency, every first world pegged currency collapsed 37% against scarce assets. Second and developing world collapsed 20% more, and the third tranche, the weak currencies, Zimbabwe, Venezuela, even Argentina, Syria, Iran, Lebanon, they're collapsing 80% against scarce assets. So now you got to ask the question, what if I don't want to own 100% Bitcoin? Mm-hmm. But by the way, it's like people think it's risky to own Bitcoin because it's volatile. That's basically myopic thinking, because what you're doing is you're putting blinders on and you're fixating upon the volatility of Bitcoin instead of looking out. How much did the volatility of Bitcoin hurt you if you own Bitcoin in Lebanon? Because they devalued the currency 90% and they seized and froze all the foreign assets. So you lost 90 to 100% of everything in 12 months. Okay, so the volatility of Bitcoin, which is up 280% in US dollars and going back and forth, is, a friend of mine says, when there's blood on your collar, your dry cleaning is the least of your concerns. Mm-hmm. That volatility is second or third order. If the airplane is depressurizing, you're worried about the hygienic standards of the oxygen mask. Who gives a crap? You're going to be dead in 60 seconds, right? When the ship is sinking and you're worried about whether you got the best seat on the lifeboat or try to figure out whether you wanted this one or that one, you're going to be dead in 2 hours. So if you have if you're Jewish in Germany in 1932, the only answer is you needed to leave. That's the only answer. There was no other answer. It was just going to get progressively worse. And you're screwing around debating whether you should take a 25% haircut to sell you. Everybody, if you read the history, first they sold their property for a 40% discount, then a 50%, then a 60%, then an 80%, then a 90%, then a 95%. Then they lost everything. Then they had to pay a ransom to get out. And if you were lucky and you paid, a huge amount of money, that came from somewhere else, you might have got out. That's what happens when you have a collapse in a socioeconomic system. So the summary is there's no diversification strategy that works in Venezuela, Benjamin. None. There's nothing that works other than you got to go orthogonal to the monetary system. So let's say in the U.S. we buy the notion that the dollar is collapsing 20 to 35% against scarce assets. And we can debate what it is, but it's at least the M2 money supply is 21% or something. The S&P is telling you that the money supply is, that the currency is collapsing 37%. That's what it's telling you based on history. So if you don't want to own all Bitcoin, then my advice would be buy a bunch of residential real estate you're going to live in the rest of your life. Buy a beach house. So I buy a house I want to own the rest of my life because the Federal Reserve can't print that away. They're not going to take 37% of my house away each year. Okay? That's good. Then I buy scarce assets. You could buy collectibles. Yeah, you could say, I mean, what is a good investment? Something that a wealthy person will want to buy from you in 10 years. Buy a franchise trophy asset. If you have an asset like maybe the Jets, maybe a sports team, if you have an asset which you think is going to hold its value and appeal for the affluent for a decade, regardless of what a politician might do, then you might want to hold that. Do you want to hold a building in New York? Well, your property rights can be impaired. The Supreme Court this week just ruled against eviction for non-paying tenants. So if you were holding an apartment building thinking that was an asset, that was impaired during the lockdown, and you can't move it. So I don't know, maybe. I wouldn't own cash. I wouldn't own a bond. Bonds have a negative 20% real yield. Now, what about gold? I wouldn't own gold. Gold is if we look at the results, what is the market telling you this year about store of value? Bitcoin is up 276%. Gold is down 2%. S&P is up 39%. NASDAQ is up 44%. And if you bought long-dated bonds, 10 to 30-year treasuries, you're down 12%, which totally makes sense because it'd be stupid to buy a 30-year sovereign debt that was yielding 1.2% interest, which is where you were 12 months ago. Should you buy Picassos, baseball cards, comic books? I mean, maybe buy a portfolio of rare art because wealthy people will probably want to buy the rare art off of you. What worked well? Single-family housing's up 25%, according to the headlines in the Wall Street Journal last week. 25%. Hampton's houses are up 50%. Luxury real estate, things that are highly desirable that people with money want, right? You want to buy. You would say Ethereum's up even more. Yeah, I mean, there's certainly small. You probably Tesla, meme stocks. You can find other things out the risk curve that have also performed well. So, I mean, you could look at those. My issue here is there's two existential macroeconomic questions you got to ask yourself. One, will a political activity impair the value of your capital? For example, will Amazon get unionized? Will Apple or Google get broken up? Will there be an antitrust action? Will it be positive and negative? Will China ban Apple from manufacturing iPhones? Will there be a tariff? Will your property get impaired by a tariff, a tax, or a regulation? Because Ben, the most valuable companies on earth, in theory, should be the water utilities and the power companies, electricity and water. But they're not, because they're regulated as monopolies. But at the end of the day, right, everybody in New York would be dead within 48 hours if I turned off electricity in New York City. So if I really, and I could kill you with the water supply faster. So if it was really as simple as providing a utilitarian value, then the utilities would be much more valuable. But what happens is eventually the politicians regulate the utilities, and then the profit leaves those businesses. So the question is, if I'm holding an equity, will it be impaired by a political act? And the second question is, if I'm holding real estate, real estate's the same way. You own a building in New York, is it going to be impounded, seized, regulated, taxed? I can tax away your property, right? You can't move. $1 billion building in New York isn't moving, whereas $1 billion of Bitcoin can move. If the state of California passes a property wealth tax that seizes 10% of all your property in California and it's a building, good luck with that. Can you sell that to a billionaire in Beijing or a billionaire in Tokyo? Not likely. Can you move it to Tokyo? Not likely. Now, here's the thing about Bitcoin. If I owned $1 billion of Bitcoin and California taxes 10% of it, I can move to Wyoming. If the United States government taxes it, and I can't, let's say the worst case, the United States government taxes it. I'm a U.S. citizen. I could move out of the country, but they still want to tax U.S. citizens. I can sell it to someone who's a Monaco resident, and they can take possession of it in Monaco, subject to Monaco tax laws. And so the value of the property is less impaired because I can transfer it to someone in a different political jurisdiction. And I don't have to worry about the mayor of New York passing an anti-eviction law on me that says is the mayor of New York going to say you can't generate yield on your Bitcoin? Because he said that to people that own apartment buildings. He said you can't generate yield on your apartment building. So there's risk in real estate. There's risk in equity. That's political risk. You have to assess it. Then the question is, what about the currency risk? If the value of the Venezuelan currency goes to zero, then every piece of real estate, every company, every bond, and every currency derivative in Venezuela or linked to Venezuela is going to zero, right? The Argentine peso was one peso to the dollar 20 years ago. It's 155 pesos to the dollar today. If you're a business person in Argentina, there is no diversification strategy. There is no investment strategy that works if it's related to anything that's a peso derivative. So you have to, and you can't keep your money in dollars. I converted all my pesos to dollars. I had $1 million of dollars. It was in a bank in Argentina. On one day, the politicians passed a law, actually by edict. They simply converted all the dollars forcibly back into pesos. The next day, they devalued the peso 10-1. And in 48 hours, they seized 90% of all the currency values in all the banks in the country from 45 million people without due process. That's what happened in Lebanon, too. That's what happened in Cyprus. That's what happened in most of these countries. That's what's happening all the time right now. So you're like, well, that's not a problem in the U.S. Well, it is. The currency of the U.S. has been getting devalued 7% a year for 50 years. Until March. And in March, it started getting devalued at a number which I thought in March, I thought it was triple. I thought it went from 7% devaluation to 21% devaluation. If you devalue the currency by expanding the money supply by 21% and you're getting a 3% yield on a bond, you're getting a negative 18% real yield. You're losing all of your money over the course. Well, you're losing half of your shareholder value in 3 years. Half. But if the currency collapsed at 37%, you're losing half of your money in 2 years. Okay, great. So most people in America have, I believe, they have a frame of reference bias, Ben. Here, the frame of reference bias is you're such an egotistical person that you're standing on Mount Everest and you jump off a cliff and you think the world revolves around you. And so you look at the other mountains and you think, wow, that's a bubble. They're really going up quite fast. There's going to be a regression to the mean. Eventually, they're going to come down. There's a lot of volatility in that other mountain. Well, the volatility is not in the mountain. You're falling, right? It's not because the other mountain is not a bubble. The problem is you're falling to your death because you fell off the mountain. Your frame of reference is just egotistical. So the same is true if you hold a portfolio of S&P stocks. If you had $1 billion of S&P stocks in March, you made $400 million in the last 12 months. Okay, so is the system screwed up? If your frame of reference is fiat currency, you think you're a genius because you have a 40% return this year. It's the best year of your life. You know, I hear stories about people sitting on their floaties in the Hamptons. They're hanging out by their pool. It was the easiest year. They spent it with their family. They made a fortune. They're getting paid a percentage. They're getting paid 20% of a 40% gain on assets. Everybody in Wall Street got rich this year. So in that environment, you don't think there's an existential risk. You think you're getting rich. But if you take the other frame of reference and you say, every company in the S&P, do you really believe that the U.S. economy is healthier by 40% this year than it was last year? No. Main Street is impaired badly by 10 to 15%. The companies are actually 10 to 15% weaker because of the lockdowns. The equities are 40% higher. there's a delamination of Main Street, of reality from Wall Street. The reason that the stock is 40% higher is the currency is 37% weaker. The reason the S&P went up 10% a year was because they kept making the currency 7% weaker a year. The real growth was the 3%. That's what's going on in the real world with risk. And if you adjust for the risk, it's like, well, it's not clear where I'm getting with this. So here's the summary. If you're actually holding a diversified portfolio of commercial real estate, bonds, and stocks and cash, you're not diversified at all. You're about as diversified as having your kids sitting on 10 different deck chairs on the Titanic. They're all sinking. It's not diversified. So you're at this intellectual laziness where you've told yourself you've diversified. But if you actually reason from first principles, from broader frame of reference, it's like, I had all my money in dollars in an Argentine bank. I didn't want to be invested in the peso. Was I diversified? No. Why? Because the government seized the dollars, converted them to pesos. If you're in Lebanon and you had all your money in dollars or dollar derivatives or anything at a centralized custodian, are you diversified? No. The government took everything. So the question here with regard to portfolio theory is, what do you think you're diversifying, right? And so you could come back and say maybe crypto is diversified from every other fiat asset. And we can talk about that if you want, but I'm going to pause because I spoke quite a bit and get your feedback.
Well, yeah, I mean, I guess there's different types of diversification. Obviously, there's the intra-asset class and then inter-asset class. And obviously you were speaking about inter-asset class among, precious metals, stocks, bonds, real estate. It's certainly easy in 2021 to make the case that Bitcoin's giving you the best returns, and it is. I mean, I spend my YouTube channel is focused on quantitative analysis, showing you why Bitcoin has been such a great tool, as long as your horizon is more than like a year or two. Because if you go back and look, there's plenty of times when Bitcoin performed really poorly for more than a year at a time. If you go back,
the question is, how can you even call yourself an investor if you don't have a 10-year time horizon?
So,
if you have a 4-year time horizon is short, a 10-year time horizon is reasonable. Warren Buffett says infinite, forever is the right time horizon. If you're saying your time horizon is a year, you're not an investor, you're a gambler. I mean, if you don't actually run the stock exchange or run the casino, you're not a trader.
Yeah, I agree with you.
Market.
I'm not disputing that. I'm not saying that my time horizon is a year, but I mean, I'm going based off what you were saying in terms of Bitcoin's up a certain percentage over the last year. Like that was the reference you were giving. I'm only giving that to. I'm using that number to suggest the rate at which the currency is devaluing in the last 12 months based on market feedback.
Okay, right? If you're asking me what time frame would I take for an investment, it's a decade. If you're asking me, here's the issue: you can look back a decade and you can consider how things have performed, but it still doesn't really solve the problem. You don't get it. I'm telling you, next Tuesday you're going to get arrested. Next Tuesday you're getting arrested, and the government's going to seize all your stuff. Are you going to tell me you need to wait a decade before you determine whether or not you should flee the country? I'm telling you, you're going to be dead in 3 minutes due to lack of oxygen. Are you going to wait a decade before you take action? If there are fundamental principles, like Facebook is operating, how many years do you wait before you conclude that Facebook is a viable business and you invest in it? Do you want to wait 30 years, 20 years, 10 years, 5 years? How about Google? 30 years? How long do you wait before you come to a conclusion based on first principles? The ship is sinking. The currency is collapsing in Argentina. Should the Argentines wait for 30 years before they decide to buy Bitcoin? Or do you have enough information based upon the fact that the peso has been collapsing every year for 15 years to conclude that you should buy something not correlated to the peso?
I mean, I agree that anyone who's buying Bitcoin with a 1 year time frame it's pure gambling. I mean, I'm not making the case that this is an investment by any stretch of the imagination, but in terms of having some slight diversification into other asset classes. I mean, people who bought Bitcoin at the peak in 2017 had to wait 3 years just for their ROI to be one, and that doesn't even include inflation. Yes.
Okay, well, I guess my issue there is like that sounds like in 2012 I met with everybody, all these Wall Street funds, and I just written the mobile wave, and my thesis was Apple's going to win. And they said, well, we think people should invest money with us because we exercise diversification. I said, tell me about that. They said, well, we don't want too much of your money to be in technology. So when technology is more than 15%, of your portfolio, we'll diversify into other into other industries. I said, well, the problem with that is that if technology eats everybody else in the world, technology will be 80%, and you're basically selling the winner to buy the loser. And if Apple stock, oh, by the way, if Apple gets to be more than 20% of technology, we'll sell Apple and buy IBM and HP. I said, well, that's stupid, because if Apple's going to eat HP and IBM, and one day, do you know Apple was 150% of all the profit in the mobile phone industry? So your diversification strategy is an awful idea if there's a winner. In this particular case, every company in the mobile phone industry lost money to sell mobile phones, and Apple made 150% of all the money. So if you are looking at a portfolio winner, there are 20,000 retailers, Amazon's the winner, Walmart barely kept up, everybody else lost, Ben. And so your diversification strategy doesn't work for retail. It doesn't work for mobile. It doesn't work for Google and search either. And it doesn't work for mobile apps. Instagram destroyed everybody, and there were 10,000 applications that they had to do at Instagram that they all lost. And so if there is a winner, what you're going to find is that there's going to be a long tail of 99.9% losers. If you do a calculation of return of the S&P 500, I think you attribute most of it to 5 stocks. 1% of the 500 companies, the FANG stocks, destroy everybody, and diversification is a losing strategy. So, just you don't diversify steel, it's steel. It's not steel plus aluminum plus copper, and that's my point here, which is you really got to think hard about what you think you're doing, because you're buying something which is 100 times riskier, thinking that you're diversifying, and it may not be. I mean, if you're buying Apple, Amazon, and Facebook, that's kind of diversification if you bought 3 winners. But if you bought the 100 companies that compete against Apple, you bought the loser, sold the winner, and you destroyed yourself.
Well, what about just within cryptocurrency? What about slight diversification just within cryptocurrency? Because that's primarily what we talk about on my channel. Is not over. I mean, I agree with you. I leave all the random altcoins to the side. I don't care about that. But if you want to talk about slight diversification in terms of just crypto,
are we agreed that all? Look, crypto is only $2 trillion out of 500 trillion in assets. Are we agreed that 400 trillion in assets are highly correlated to the strength of the currency, and therefore they're not really diversified if you're holding a market basket of them in a given country? Are we agreed on that?
Yes, but my point is if with Bitcoin, if the idea is that there's only one winner, why would you pick everything else that's sinking relative to the returns of some other, what I would consider to be somewhat interesting investments like Ethereum? You could argue that Ethereum has significantly outperformed Bitcoin over the last year.
Before we go on to that, I just want to make sure that we're agreed on the other point, which is most assets in the world, right, are not in the crypto system.
Yes, I agree with this. Of course, I agree with this.
And there's a lot of political, economic risk that's all correlated, right? Most assets in Venezuela are all correlated because of the political risk of government control of Venezuela, and assets in the dollar or the Lebanese pound or Syria or Iran, they're all correlated. So we got to just keep that in mind. So when people talk about portfolio theory and diversification, if you're diversifying in a market basket of assets that are politically correlated or currency correlated, you didn't diversify at all. Are we agreed on that?
I mean, I think that I'm sort of not saying you need to go out and buy everything out there in the world, but I'm saying if you have some crypto, if you have some Bitcoin, are you arguing that your entire portfolio
you don't want
should
to
just be
talk
100%
about
Bitcoin?
You don't want to talk about alternate assets. All you want to do is talk about crypto.
No, I do want to talk about alternate assets. We talk about alternate assets. This is what I'm saying right now. Is
okay,
are you
well,
arguing?
let's come back to that because we still can't we can't get to a conclusion. Can you agree that all of the businesses and all the commercial real estate in Venezuela is correlated?
Yes, but why do we keep talking about Venezuela? I don't think anyone here, most people I don't think are that interested right now in exactly, someone investing in Venezuela. I'm speaking about, are you suggesting that 100% Bitcoin portfolio is the only way to go that makes any sense at all?
We'll get to that. Okay.
Because I know you've made a lot of money on stocks.
I'm trying to expand. I'm trying to expand your frame of reference because your frame of reference is pretty narrow. It's basically 0.2% of the assets in the world.
So I own
0.2%.
So that's not true because I own more equities than I do crypto. I think you're misunderstanding. I'm not saying we're only talking about crypto. We talk about plenty of other things besides crypto. This is what I asked you about originally was slight diversification, I think, is fine. Are you suggesting that a 100% Bitcoin portfolio is the only way to go? And if not, is your, I don't want to ask you, your own personal, your own personal stuff, but it just seems like if you think there's only one winner, then anything short of 100% Bitcoin is a losing portfolio.
Yeah, again, you keep using these broad words, portfolio, but what you really mean is crypto portfolio, right?
No,
if you're asking me a question about portfolio,
I'm not asking about it. I'm saying let's just pretend Bitcoin's the only cryptocurrency. Is a 100% Bitcoin portfolio the only one that's the true winner?
Is it better than having other things? I think Bitcoin is the apex property, so it's definitely the safest, least impaired property. So I would be overweight, if not substantially, Bitcoin. What else would I hold? I would have a small amount of working capital in a local currency because you have to pay your bills. Sure. So like MicroStrategy carries 1 year worth of cash. I would own trophy assets that I love.
Okay, this is what I was trying to get.
I would own a house, own a second house. If you're a business, you could own your own building, right? If you want to own a sports team, if you want to own a basketball team, if you love the asset, if you love art and you want to own trophy art, I think that that my view in the current environment, because we've got the first most important point is everywhere in the developing world, the currencies are collapsing. And in the developed world, the currency is falling 20 to 30% or more, devaluing against scarce assets. So if I'm constructing a portfolio in the US or Europe, I would construct a portfolio where my primary investment would be Bitcoin because it has the potential to go up by a factor of 100. It has a massive upside, and it also serves as a large monetary inflation hedge, and it's apex property, and you can take custody of it. And then the other things I invest, I wouldn't expect this. You're not going to get a 100x return on your house. Right. If you're owning your home, you can probably expect it to be a monetary inflation hedge, right? Single family homes up 25% maybe. If the dollar collapsed by 25%, what you got was a straight inflation hedge on a high quality piece of real estate. And then you might, if you owned a market basket of high quality tech stocks, if you own technology, then if anybody's going to be able to navigate a collapsing currency market, it'll be big tech. It'll be the Facebook, Google, because Apple can ship a new product to 2 billion people over the weekend for a nickel. And so they have hope, at least they have a possibility, either between their power and their distribution and their dynamic. There's hope for them.
Okay.
I think that the value stocks, if you own low growth value stocks or low growth like commercial real estate based upon rents, those are actually they're like bonds. They're all fixed fiat cash flows, and if the discount rate goes to 20%, then the value of all those things collapses, right? So the riskiest thing would be to hold bonds and bond-like real estate and bond-like equity, because there's no way for them to increase their cash flows by a factor of 10 or 100 by inventing a cure for cancer or something. So that's what I think about that. And now if we go to cryptos, look, I think the issue there is, if you look at the entire crypto ecosystem, you've got three types of things going on. You've got digital property, you've got digital currency, and you've got digital applications. Digital property wants to dematerialize or demonetize existing property. So if I can convince you to buy a Bitcoin instead of a building, or a Bitcoin instead of a block of gold, right? Then that's property. And those are optimized for integrity and durability. Right? What I want is something that'll last 100 years without anybody screwing it up. And so you'd want to have a network that's got the highest hash power. You'd want the most conservative ethos. You don't want to change it. You don't want bells and whistles, and you don't really want innovation going on the base chain. Like in the base, you don't want innovation, right? The innovation, the theory of property is, I own a block of granite in Manhattan, and I don't want to change that. You can build buildings on top of it, and you can launch businesses on top of it, but the land is the land. Okay, so all the innovation in like a Bitcoin property ecosystem goes at layer 2 or layer 3. It's Lightning, it's Square, it's PayPal, it's Fidelity, it's MicroStrategy. We're the innovators. We're taking the risk. We might fail. But Bitcoin doesn't need to do anything other than just like stay secure with integrity. So a property crypto, the architecture is proof of work, and the ethos is durability, integrity. You don't want big blocks. You don't want to screw with anything. Don't change anything. Just leave it the way it is. It's fine. It's already done. Occasionally you might tweak it to make it more secure, more private, Taproot, right? Things like that, reasonable upgrades. Maybe one day we'll improve, some small piece of it, but 21 million coins running a block every 10 minutes, clearing up to 350,000 transactions a day, 100 years from now, it's going to be fine. You could store $100 trillion of energy on 21 million blocks of Bitcoin. 1,000 years from now, it would work great. You don't have to change it. And you could build 100 million businesses on it, and they could all integrate with it different ways. And and then when you go to the next layer, the platform layer, well, the risk increases, right? And that's fine. So the second part of the crypto ecosystem is digital currency, like Tether,
right.
Stablecoin. There's no upside to them. They're basically fiat derivatives.
Right.
It's like running a money market fund in cyberspace, and Tether could scrape off a 70 basis point yield off of $50 billion. And maybe that's a good business for them, and maybe not, but it's not that interesting. So let's just leave it at that. They'll be regulated as currency with KYC, AML restrictions, and they're primarily going to need to be compliant and compatible.
Are you at all interested from just like and let me know if we're running late or anything like that. But are you at all?
No, we're good.
Okay. Are you at all interested? I agree. Bitcoin, it's the apex, right? I don't contend that any other crypto even comes close to it in terms of what Bitcoin's doing. In terms of where the world is today, in terms of Ethereum being, programmable money, the ability to have smart contracts, decentralized finance, etc. Do you think that is interesting in any way to merit an investment, not an investment that, say, competes with, not something that's saying to overtake Bitcoin, because I don't think that is, but just as an investment like you might make in Apple, like you did one day, or Microsoft, or whatever it could be, or Facebook? Do you think there is any merit from what Ethereum is doing?
Yeah, so let's go to that. So how do I analyze that entire part of the ecosystem? Once you've gone beyond digital property and digital currency, you've got digital platforms and digital applications. Okay, the idea of a digital platform is you want to dematerialize. I guess you're dematerializing AWS or some other operating system. You're dematerializing a little bit of what are the platforms people use today. They use AWS, they use Azure, they use iOS, they use Android, they use Windows, right? They use those platforms to build applications. And Ethereum is decentralized platform to build applications.
Massively, Bitcoin and Ethereum are the two most massively decentralized protocols. Like, I don't think anything else comes close to that.
I get it. So Bitcoin wants to dematerialize or demonetize property. Ethereum would like to dematerialize insurance companies and banks. And it's a real question. Are they dematerializing the operating systems and they're competing with AWS and Google and Microsoft and Apple? Or are they competing with Fidelity and JP Morgan and insurance companies and NASDAQ and New York Stock Exchange? You could say the platform is competing with raw technology and the big tech companies. And the applications that run on the platform are competing with finance companies and other types of banks. So what do I think about that? Well, I think it's complex and competitive, and it lacks regulatory clarity. I mean, the three big risk factors. The risk factors are clarity, competition, and complexity. It's a lot more complex to create a decentralized exchange, right? Look, DeFi, a decentralized exchange is competing with Binance and Coinbase, in addition to competing with NASDAQ and New York Stock Exchange and the like. So obviously, you have to build more functionality. Applications need to be optimized for functionality and performance. Bitcoin doesn't need. Property needs to be optimized for integrity and durability. So if you're going to add functionality and performance, that creates an additional risk factor. You got a lot more competitors, right? So is Ethereum competing with big tech, or is it competing with Binance and Coinbase, or is it competing with Solana and Binance Smart Chain? I mean, or is it competing with Cardano?
I mean,
right?
Yeah, but Binance Smart Chain and Solana, they're very different. Binance Smart Chain is to some degree is very centralized compared to Ethereum.
I get it. I get it.
So I guess my question
the risk factors, by the way, the fundamental risk factor is if these things become viewed as centralized, then you've got a regulatory risk that the regulators will call your token a security and shut it down.
Right. Yeah. And I'm not saying that, that some, you could argue, there's always the argument about decentralization versus centralization, and there's just sort of, there's trade-offs between the two. Of course, there's trade-offs between the two. But with Ethereum, it's regularly settling like 2 to 3 times the value that Bitcoin is, and that doesn't even include decentralized finance. So my question is to you, is it interesting enough for you to ever invest any of your own dollars into Ethereum? And if, what would have to happen?
It's venture, Ben. It's venture capital, right? This is you're speculating that you're going to replace centralized exchanges, and you're speculating that you're going to replace other businesses that do this, and you're speculating that you're going to compete favorably against big tech, right? And you're speculating that you won't get beaten by another competitor, and you're speculating that the regulators won't regulate it. But Look, the regulatory risk of using crypto as a currency is much higher than using crypto as property, right? So if I have $1 billion and I store it in a regulated exchange forever and I don't move it, that's least risk. If I try to move $1 billion around as a stable coin every minute of the day, that looks like it's violating money transfer laws. And so the regulatory risk of using stuff high speed goes up. The regulatory risk of trying to replace a stock exchange or a trading exchange or a commodities exchange with a decentralized exchange, DeFi is non-KYC. So is it the obvious issue that if you're trying to dematerialize or replace an exchange, you're inviting the regulators of the exchange to regulate you? So the CFTC will have an interest if you're actually trading commodities. If all of these things are deemed as, have you noticed what's going on right now? If what they'll say is we're not regulating spot market ETH and spot market Bitcoin because there's a general consensus that ETH 1.0 and Bitcoin are property and it has not been overturned. Okay, right. That's about the only regulatory consensus in the world. There isn't consensus about the definition of a security token versus a commodity token. And certainly there's a lot of resistance to trading in futures and derivatives of these underlying commodities. So if you're actually creating something, we have centralized exchanges right now, centralized exchanges that are trading derivatives of commodities and they're getting regulatory heat, right? We don't have to talk about it, but you can see it. Now, if you have a decentralized exchange that also trades, potentially trades commodities without KYC AML, which is the whole point of these things, then they're also going to get heat. So here's the way I would break it down. I would say if you have a bucket of capital that you want to invest conservatively for a decade or longer, you would buy digital property. If you have a bucket of capital that you would invest in companies, right, then like a Apple or Google or that, then maybe you think about the dominant crypto. But I would say, if I had to boil it down, I would say you've got Bitcoin as a risk-off asset. Ethereum is like a unicorn. It's like an Airbnb or an Uber, and you may get extreme amounts of money, but it also could be WeWork. And you have to think that through. And then you've got all the other cryptos, which look like ventures. And if you have a venture capital fund and you're looking for a 100x return on your money, but you're ready for 95% or 99% of your ventures to go to zero, then I think you could play in that. There's a 99% failure rate with mobile apps. There's a 99% failure rate with most ventures. And so I think most of the cryptos, you're speculating, it's either a gamble or it's a venture. I think that Ethereum has been the most successful because it was the most decentralized of the smart contract platforms, and that's an advantage for it. But there's just a lot of complexity, a lot of uncertainty. Like what happens between ETH 1.0 and 2.0? When will that happen?
Right. That's a big thing. Yeah, that's a big thing that carries some uncertainty.
And it's ambitious, and the problem with the ambition is, you're inviting insurance regulators, commodity regulators, securities regulators, intellectual property regulators, and money transfer and banking regulators all into your world as you pursue ambitions. And the less ambitious you are, the least ambitious you are, the less you invite that scrutiny. So if your use case is, I'm just going to buy $1 billion worth of something and put it in a regulated custodian and not touch it for 100 years, you can probably jump through the KYC AML hoops, and you don't actually touch on the issue of futures trading and regulatory arbitrage. And of course, the likelihood that you're going to do a flash loan trade and lose your money goes way down. You're sitting in cold storage. So I think that the right answer to this is you got to figure out what your risk profile is. If you say if you define the world as the only thing I'll ever invest in is crypto and I need to be diversified, I think you might be taking too much risk in some of the cryptos. That's the same as defining the world as the only thing I invest in is stocks in Venezuela, but I must be diversified.
Yeah, I think 100% crypto portfolio is not a good portfolio by any stretch of the imagination.
You have the big uncertainty is regulatory behavior because we don't have clarity right now.
I agree.
And the world it'll be 3 to 4 years before you have clarity. If someone were saying to me, what should you think? I would say, go on YouTube and watch 25 hours of Gary Gensler's lectures on blockchain and money that he did at MIT in late 2018 and listen to him. And I think that he takes the position that he says, I'm not a maximalist or a minimalist. I think it's possible to have permission to block chains, but there's this question of what are you trying to do? And you're going to have to come into a regulatory compliant environment for that. So I think you got to consider that thing very carefully. And then as an investor, I think the message of investing is that 99% of the ventures fail and 95% of the big companies don't perform. 90 to 95% of the S&P 500 is a loser in the last 10 years. The winners are Microsoft, Apple, Amazon, Google, Facebook. I mean, the winners are outstripping the losers. It's a winner take all. So you have to really find the winner. And if you're actually selling the winner to buy the losers, then you're in trouble. There's a lot of investors that have pools of strategic capital where they have to buy certain things. So if you have to buy fixed income, then of course you're going to actually diversify your portfolio with that constraint. If you have to buy equity in the US, that's your constraint. If you have to buy small mobile ventures or tech ventures, that's your constraint. I think for the individual, right? If you're talking about an individual investor, it all comes down to what country are you in? What country do you expect to be domiciled in? And then you have to just work your way through your currency exposure, your political exposure. And, what portion of your money do you want to gamble with? If someone wants to buy GameStop or they want to buy AMC and a meme stock, I wouldn't begrudge them that. If you want to go to Vegas and bet a ton of money on black, I wouldn't. It's your business. If you want to bet on sports, that's fine. If you want to buy some stocks because you like the CEO, that's fine. If you want to buy some whatever, you're just taking different types of risk, probably a lot more risk, in my opinion.
Oh, I agree. I agree. I agree. It's a lot more risk in terms of crypto. Taking on past Bitcoin is definitely riskier. I have a question because you've mentioned a lot about regulatory risk. What is the main regulatory risk, if any, that you see for Bitcoin?
Bitcoin has the least risk of any crypto by an order of magnitude, maybe 2 orders of magnitude.
I agree, but are there any types of risks?
Because it's the least ambitious. Because its ambition is to just sit there for 100 years. If it is properly understood as property,
right?
When people start to say we want Bitcoin to be currency, and then and you move beyond it, the risks are as you pursue the extra use cases on the base layer. And if you pursue the extra use cases on the layer 2 and the layer 3, the risks all accrue to the layer 2 and layer 3 applications, which are companies or projects, right?
Right. Yeah, I prefer Bitcoin as you prefer it. I don't think about going and buying my coffee with Bitcoin personally. I know some people do, but that's not what I use my Bitcoin for.
So I think it's just FUD. The only real risk to Bitcoin is FUD. Like it's not if you're holding Bitcoin for a decade, I don't see the risk. If you're asking me what's the risk in the next 3 weeks, well, somebody might say this or somebody might say that. Like random media opinions are the big risk.
Are you worried about any type of government intervention, or if it or anything like that? Or is that something that you think is worth considering, or you think it's sort of one of those things where there's nothing they can really do anyways?
Well, Ben, the government's already intervened. the government is intervening, right? So in 2014, the government designated Bitcoin as property and not currency, right? Probably the single most important intervention was the IRS saying it'll be taxed as property. What that meant was that every single transfer of Bitcoin was a taxable event, an accounting event. And that meant that it's not currency in the US.
Right.
Like, that's very clear.
Yeah.
For it to be currency, it has to be non-taxable on transfer. So that designation as property was pretty material. I think the government's been pretty clear that they're shutting down any exchange that doesn't exercise AML KYC.
Right.
Right? Look at the BitMEX thing, right? I mean, didn't they bring charges? So the government's going to they're going to put in place anti-money laundering rules, know your customer rules. You're going to have to pay tax on it. When you transfer more than $10,000 of it, they're going to track it. So I expect that. The questions are going to be clarity around trading derivatives, Bitcoin futures. The questions are going to be around trading tokens. You know, can you take an equity and turn it into a token, put it on a smart contract chain and trade it DeFi? Well, a lot of the world would like to do it. I somehow think that the SEC is not going to like the idea of you being able to trade securities derivatives without AML KYC. Like, I don't think you're allowed to trade. You can't trade with more than 50% margin right now. Like, so you can't have more than 2x leverage on regulated securities exchanges in the US. And there are very defined regulations about how much leverage you can take with derivatives, like interest rate swaps. Like, if you want to take a 10-year or 30-year interest rate swap, that was all driven by Dodd-Frank, I think. And the regulator that oversaw that was Gary Gensler while he was at the CFTC. And so there's a lot of regs around leverage and counterparty risk and transparency with commodities and with securities. And then there's a lot of question about what's a commodity and what's a security in the crypto ecosystem. And there's a lack of clarity there right now. And of course, that changes country by country. So as regulators in Japan, in the UK, in the US start to get their hands around what constitutes a commodity, what constitutes a security, then they'll actually start to form views on jurisdiction. I think in Gary Gensler's testimony to Congress a few months ago, he actually noted that there are areas of question where it's not clear the SEC has jurisdiction to regulate certain parts of the crypto ecosystem. Well, the implication being that maybe as policymakers form opinions, will that jurisdiction go to the CFTC or the SEC? Or, if it's with the CFTC, the SEC doesn't have jurisdiction. If it's with the SEC, they do. Right, and so so you've got a delay, and as they actually roll out those rules, then that will ripple into pronouncements about what centralized exchanges can do. You see the regulators are actually giving guidance to centralized exchanges, right? Their exchanges shutting down, in Japan, or closing off certain services in Japan and China and UK. I can't trade, as an American citizen, I can't trade futures, on some of these exchanges like Binance and FTX. I'm blocked from it, right? So if there's regulatory guidance coming to centralized exchanges, don't you think that it's also coming to decentralized exchanges and smart contract platforms after that? And so you got to expect, if I was looking at this, I would be studying what the regulators give or what guidance they give to Binance and FTX, and then what can you do in the US as a U.S. citizen. If you can't do it on a regulated custodian in the U.S., I would assume that you're not going to be able to do it on a decentralized exchange. There's no way that an American citizen is going to be able to trade. They're not going to be able to trade futures of Bitcoin on a DeFi platform legally. If they can't legally do it on Binance and FTX, they're not going to do it on DeFi. So if you're constructing that business is a gray market business, which might be legal for some pool of capital somewhere in the world. But if it's not legal for capital in the United States and Western Europe, then it's going to be a small segment, never a mega segment. Sure. There's a big question, all sorts of interesting questions like, PayPal and Square allow you to buy Bitcoin, but they don't support Lightning.
Right.
Why? Like, ask yourself that question.
Yeah.
And so where will that land? I think it's going to be a regulatory haze. Like, I'm not saying that they're going to actually clarify everything. They probably won't. There'll probably be just this rippling stages of it's getting a little bit clearer. For example, you can see that institutions are getting more comfortable holding Bitcoin in the past 6 months than they were 12 months ago. But,
I want to ask you a question.
It'll just be like unpeeling the onion bit by bit.
Yeah. I want to ask you a question about that. I'm really curious because I know you've been paving the way in that world. So now that I have you, I just want to ask you, like, if an institution decides, like, hey, we want to buy Bitcoin, what sort of process, like how long does it take them from having the idea to then actually having Bitcoin on the books? Like, is it something they can do in a week, a month? Like, I know you guys have it sort of streamlined more now, but when you first started, like, how long did that process take?
Okay, well, it's changing because a year or 2 years from now, most of the major banks will actually handle Bitcoin. And then you'll be able to call up your existing prime broker or existing bank, and you could probably do it quickly. Mm-hmm. A lot of times institutions have accounts with banks or prime brokers that they've had for 20 years or 30 years. Like if I'm using Bank of America for 20 years, it might take me a year to set up a new banking relationship. So the on-ramps to all these asset classes are these existing institutions. So if I look at where it is right now or where it has been, if a big institution or a big player wants to get in, well, now the question is, are they public or private? If they're public, you're going to spend 6 to 12 weeks just going through the internal deliberation. And then you're going to spend at least another 6 weeks getting onboarded. And so you're talking two quarters, 6 months is the fastest it would happen if you're public. And the real impediment for public companies is this consistent with my charter, and what about my shareholders and what do they think? And I have to rotate my shareholder base, or I have to telegraph this. So that's the challenge in the public market. And that's the most problematic because I have a very complicated shareholder relations problem to manage. Mm-hmm. And also accounting in the Western world for digital assets is indefinite and intangible. So it's not a terribly good accounting method, or it's not desirable. If you're a public company CFO, you can only write down the asset. You can't write up the asset. You can't recognize your investment gains. So it's prejudicial versus investing in other types of financial assets like debt or equity. So that's that. If you're a private company, you probably spend 6 weeks thinking through it yourself and 6 weeks to get onboarded. 12 weeks.
Okay, so about 3 months or so.
3 months if you're private. If you're a private investor, though, right? Like if you have a fixed income fund, you couldn't by charter do it without changing the fund. Right? You can't go back to all the pension funds or what. It might take you a long time. So people often ask, like, well, why would someone buy a bond from you instead of buying the Bitcoin? Well, the answer is because they have $10 billion in a fund and they're only allowed to buy fixed income. or they're only allowed to buy public equity on the NASDAQ or the New York Stock Exchange. They're not allowed to buy Bitcoin. It would take them 3 years to go back and change their charter to buy Bitcoin.
Right.
So a lot of investors have mandates and they have limited partners, and if I raised $10 billion from 47 pension funds and they expected me to do convertible arbitrage, and that's my business strategy, then when I bring a convert that's got some Bitcoin exposure to it, then they can buy $25 million of that in 10 minutes. But if they wanted to buy the Bitcoin and do it themselves, it would take them 3 years. And of course, maybe they can't arbitrage because they don't like the futures, like they don't have the prime brokerage relationship. Like the counterparty risk is huge. If I'm going to lay on a $500 million or $100 million trade with you that settles in 2 days, you think I'm going to do that with an exchange in Singapore that I've never done business with in 30 years?
Yeah.
No, that would take me a year. Right? And so what you have is a lot of inertia in the system, if that's helpful. What other questions do you have?
Yeah. Sorry. I know you don't. I've watched some of your talks and whatnot. I know you don't necessarily subscribe to any type of cycle theory. I generally think that this cycle, or whatever you want to call it, the Bitcoin's just going to generally move up over the next several years. And I mean, I think from a institutional perspective, it's going to take these institutions a while to come on board. I will say that I think, I think I speak for everyone in saying, everyone's really appreciative for all the work you've done with, on sort of paving the way there. And that brings me to this, to this question of like, what do you see for your career over, say, like the next 5 to 10 years? Like, do you see this like continuing to do this? Like, where do you see yourself going over the next, say, 10 years?
I think that the creation of digital property is more profound than the creation of digital music or digital photos. But clearly, digital photos, digital art, digital music, digital education, digital property, these are the digital relationships. These are the things that define the 21st century, right? And Facebook and Amazon and Apple and Google, they all did digital something. I think Bitcoin is digital property. I think that digital property is the apex property. If there's $500 trillion worth of money in the world and half of it wants to find a long-term store of value, we've monetized a lot of physical 20th century things as property. We've monetized art and gold and stocks and real estate and land and currency, and I think that when Andrew Carnegie wanted to educate the world, he created a system of libraries, right? And you see them in every city in America. He spent a lot of money on thousands of libraries. Well, digital books, right, dematerialized the libraries. And now when that happened, you released all of this energy because you collapsed to a more efficient crystalline structure. Mm-hmm. When steam collapses to water, collapses to ice, you give off energy, right? Exothermal reaction. So it's a chemical reaction. When we collapse, and all of the information content falls out of the libraries, the universities, and the books, you give back tens of billions, hundreds of billions of dollars of energy. And in theory, what's the value of giving 100,000 books to 5 billion people as electrons, right? Like it's a $1 trillion, multi-trillion dollar capture of energy or avoidance of friction when I did that. If we take all of the monetary energy out of gold and out of land, and it collapses into the Bitcoin blockchain, any kind of digital type network, then what you've done is you've released tens of trillions of dollars of energy, perhaps hundreds of trillions of dollars of energy into the human race. It's basically humanity operating at a much more efficient level. It's like putting electricity into every house. If I give you 400 horsepower worth of electricity in your kitchen. It's a lot easier than putting 400 horses in your kitchen, right? I mean, that's impossible. This changed things. And so my view for the next decade is I simply want to make sure that we commercialize digital property. Bitcoin is electric money, and figure out how to roll it out to billions and billions of people. Ultimately, I think that 8 billion people on the planet have a mobile device, and that mobile device has a digital wallet, and that digital wallet has digital currencies like the dollar or the euro, and it has digital assets. And I certainly think Bitcoin will be the apex, the best one, but there'll be other assets, your favorite stocks, maybe your favorite NFTs, maybe your favorite smart, maybe some Ethereum, whatever it is, it'll be digital assets and digital currencies, and the market will determine. The weak currencies will get destroyed, like the Venezuelan currency, the Argentine currency. There's 100 of them. They're all losing their currency privileges, and the world's collapsing to like dollars and CNY, probably. And the weak assets will get destroyed. You're not going to use, who wants to store value in a 30-year bond that yields 2% interest, right? Presumably they'll get demonetized, and gold, for example, is getting demonetized, and the strong assets will accrete. So that's my interest. Like, how do you make that happen? There are a lot of ways. Introduce this to institutions, work to educate the public, work with the regulators to provide clarity on how to do it, deal with the FUD, stretch out people's time horizons. Can we talk a little bit let's talk about speculation and modeling. I think this is an important point to make. I don't think you can look backwards at charts to figure out what's going to happen next when you got a technology. See, if you were trading commodities with no technology influence, like you're trading corn versus soybeans versus, cattle futures, you could probably study your charts all the time and look for regressions to the mean, and you could plug in your weather patterns and the like, and you might come up with some trading algorithm. That doesn't work if I invent the new magic corn that you grow it once and it feeds someone forever. All of your models don't work. If I create fusion and a little sugar cube will act, if I have nuclear powered cars, that operate on a nuclear reactor that big, all your historic models don't work anymore. When you manage to create digital photographs and you upload them to an iPhone, all of your models about competition in the PC industry, or like which of the camera companies are going to succeed, Kodak or Panasonic, or none of them, right? If you introduce a new technology that's 2 orders of magnitude or 3 or 4 better, then all of the trading algorithms, all of the wisdom of traders, of speculators, of chartists, none of it matters, right? Like I try to explain this to people. I look for like the most brutal way. Like, you're a very educated person. You have a PhD in nuclear physics, nuclear engineering, right?
Yes.
And you know everything there is.
Yeah, I'm the first to say on my channel that all models are wrong, and some provide useful insights, but they're all at their core, they're going to be wrong. And I don't make any claims that any model is going to tell anyone what's going to happen by any stretch of the imagination.
So if I walk into your room while you're doing all this trading and I take a gun.
What trading are you talking about? I'm not a day trader. I don't trade. Like I generally.
Let's say every single thing if I walk into your room and I hold a gun to your head, the only question is it loaded and will I pull the trigger? And everything you've learned in your entire life is irrelevant. There's one thing you need to figure out is it loaded? Will I pull the trigger? How do you keep me from pulling the trigger? Everything else becomes meaningless. And I feel like that. Why is that? Because I introduced a new piece of technology or a new possibility into this system. If the system is closed and adiabatic and there is no new energy source, you can solve the problem in a closed system. But if the system is open and it's possible for for someone to show up with a new approach, which is it might be for example, if Bitcoin is digital property and it demonetizes all other physical property, then $100 trillion of money is flowing into Bitcoin. And everything you've studied about Bitcoin in the past 15 years, all billion pieces of information are irrelevant. One of my beefs that I have with the crypto community and with the traders is they're very myopically self-centered, and they're focused upon their experiences, and they try to relate everything to what they've lived through. And none of them hasn't expressed an opinion as to whether or not a fixed income mutual fund will buy Bitcoin. And my point is, if there's $100 trillion of money in fixed income mutual funds, whether they will buy Bitcoin, which you don't know, is more relevant than everything you do know and everything you've ever done and every single success you've ever had. They're all irrelevant compared to whether or not someone that is not in your ecosystem chooses to enter with amount of energy, which is 100x greater than the amount of energy you currently have under your control.
So I also, to some degree, I think you're projecting what your experience on other channels may be onto mine. On mine, we look at a lot of charts that just show things like, while the 1 year ROI, it can be bad sometimes, the people that stick around for years and years, these are the people that gain the most. It's basically complementary to what you do. I just stick to the data. I don't project my opinions. I show the data for what it is. We have, all sorts of charts showing like the ROI over various timeframes and whatnot to try to educate people on why, a lot of times people get scared off from Bitcoin because they buy whatever the local top is and then they capitulate when it's 50% down. I try to educate people on, hey, look at the models, look at the data, look at what it's done, and it's not going anywhere.
Ben, my point is, the question is what data? Like, for example, what if I told you that all of the data of every trade of Bitcoin and Ethereum since the beginning of time and every other crypto trade and every result and outcome of everybody in the crypto ecosystem is all irrelevant data? The relevant data is whether or not one dude with $10 billion decides to buy Bitcoin tomorrow. And that's not in any of your charts and any of your data. So you can look at any data you want, but saying, well, we look at data can be a crutch because people just look at their data. Are you looking at the data of whether the 10 richest people in the world are going to actually invest $100 billion in Bitcoin tomorrow?
Because you also look at data. You spent a long time talking about, like how everything's depreciating, like the US dollar's appreciating, everything's depreciating, Bitcoin's up a certain amount in a year. This is what we do on the channel as well. I just do it visually with charts. The same thing that you're doing when you speak. I like to visualize things as well. I'm not saying that I can predict what's going to happen. I make no claims to know what's going to happen by any stretch of the imagination.
I'm not critiquing whatever you've covered. I can't presume to know. What I'm observing is that if I look at Twitter, I look at what I see, and most of the chatter, people tend to be very myopically focused upon their own trading data, and like they want to extrapolate Bitcoin's future from Bitcoin's past, or they want to extrapolate some crypto from the crypto past. And so they tend to take a very closed system view. They think that they're a closed system. And I take an open system view, which is, for example, what will every politician in the world say? What will all the relevant issue is, what about the $400 trillion that's not in crypto? That's relevant. Right. The other point is, I think that most of the traders, they're not technologists, so they're trading the stuff, or they're talking like they're thinking it's commodity, and they're comparing it to other commodities or other things they can trade. But like, for example, let's take Apple. Apple was the winner. And you could not have predicted Apple was going to be the winner in 2010 based upon all the historic trading data of every company imaginable. But you could have predicted it would be the winner if you simply used the phone. If you used the Apple iPhone and you compared it to Windows and the internet, you could have said it's very obvious this is a better user experience, and one day 1 billion people will want that. And if you combine that with one other observation, I travel around the world and I see the Apple software is better, and I see every wealthy person's using an Apple phone and an iPad. And the conclusion is Apple is going to win the entire affluent market, and then they're going to build the entire ecosystem of Apple everything. And you're extrapolating from a product experience about where the world is headed. Just like Google Maps. You look at Google Maps, say this is better than a physical map. You could have said one day 5 billion people will want to use Google Maps because it's better. But there is no data in the trading world that you could look at that would support that. The data set that would support it would be how many people live on Earth, how many people can eventually afford a $50 Android phone, right? You could, if you look outside of the system and you pull macro trends and technology trends from outside the system, then you can forecast the impact of technology. But if you look inside the system, then all you're going to do is look at trading patterns, and you're playing with these closed models. And I just feel like the closed models don't really give you that much insight. They're generally pessimistic, and the people that have an interest in pushing them, they typically want people to trade in and out of things because they're looking for some signal. They're looking for a signal that says Bitcoin is cheap or Bitcoin is expensive or whatever, right?
I for the record, I'm not day trading. I have no interest in people trading. I don't even post affiliate links or anything like that. I don't have any interest in that. I think that that's not a good thing, and that most people are probably going to lose their money if they go out try day trading using whatever algorithm they want to use. So that's not what we cover on my channel. I mean, to give you an example, like if you just want to see an example, here's a chart that I sometimes present on my channel. And I mean, I'm not necessarily saying that Bitcoin has to follow any type of trend, but in terms of educating the public on, sometimes Bitcoin can have a bad year, but it generally trends up with time. This is a logarithmic scale, the 1 year, 2 year, 3 year, and 4 year ROI. You look at this and you can see exactly what you were saying earlier, that, no investor is buying Bitcoin with the idea of holding it 1 year. It's gambling, right? It's pure gambling. But if you hold it for a long period of time, at least what Bitcoin's history shows is that it works out really well. I would agree that it's a very deterministic view to say that just because it's happened before is a reason for it to happen again. But by showing these charts to people, I've been doing the channel for over 2 years now. By showing these charts to people, it did allow some people, I think, to have a different view on Bitcoin and to stick it out for the long haul rather than capitulating whenever it drops, a few percentage points or whatever. These are the types of,
but you can't really, you're not really showing the future. And it's like if I said to you, you can build your building with steel, or you can build your building with clay or bricks. I mean, isn't there a different observation, which is like, I have a gun, you have a bow and arrow. Here's a gun, let me shoot it. Okay. Are you going to show me the statistical history of all the fights with bows and arrows versus guns? Or are you just going to show me the gun? With Bitcoin, you could just give property to 5 billion people.
Right, but I mean,
the historic ROI of Bitcoin isn't really as relevant as giving the thing to 5 billion people, right?
Right. I mean, I agree that it's not necessarily as relevant, but I'm just visualizing the same things that you discussed when you were discussing the annual returns of Bitcoin in your tweets and on this video versus other assets. Like, it's just a visual.
I guess the other problem, Ben, is like you got all these charts, but you're still missing like the big thing. The big thing that happened was the currency collapsed 37% in the last 12 months. All your charts are in an environment where the currency was collapsing 7%. Like once you go before March of 2020, the currency was weakening at 7% in North America. So
I mean, I have charts that plot the value of Bitcoin against other assets as well. I don't only look at the US dollar.
I'm just saying that, like, you live in charts, and if you live in charts and you want 10-year charts, well, you didn't have 10 years of the currency collapsing at 37% a year. You have 1 year. Okay. And so if you have jarring, jolting changes, you didn't have institutions buying Bitcoin for the 10 years. Institutions started buying Bitcoin in August of last year, 8 months ago, 9 months ago. So when you actually spend tons of time looking at historic trading charts, you underweight technology and socioeconomic developments that are material, and you overweight statistical patterns in the closed system as it no longer is.
I'm not calling them trading charts. That's what you're calling them. I've never mentioned them as trading charts.
Yeah, but you're showing me ROI of Bitcoin in 2016. It's
the running ROI. It's basically to educate people on the fact that, yeah, like there's going to be volatility and you just sort of have to live through it. It's basically the same stance that you have. It's just I'm visualizing it. I mean, we just had downward volatility in Bitcoin. It dropped 50%, right? So who cares, right? I know you don't care. MicroStrategy doesn't care.
I guess my issue is people are looking at these things and debating them. But if I told you the currency was going to collapse by 90% next Tuesday, wouldn't it be more material to point out to people that the currency is going to collapse by 90% next Tuesday than to have them study the last 10 years of trading of a lot of complicated things?
I don't think it has to be black and white. It doesn't have to be one or the other. And also by saying something's going to happen next Tuesday is also a very deterministic thing. I mean, you're basically saying that something has to happen.
But it is black and white in Argentina and in Lebanon this year. It is black and white.
It's not black and white everywhere.
It's black and white, but it's black and white in a lot of places. And the
black and white in like a few countries doesn't mean it's black and white in every single country in the world.
Yeah, so I guess we come back to this issue of either you're a technologist, I hold the iPhone and I say Apple's going to win because it's good, or you're a chartist and you say, I just want to look at the statistical performance of Apple stock versus other stocks for the past decade and see whether or not I like it.
Why can't you be both? Why can't I believe in Bitcoin from a fundamental perspective and also be interested in looking at the charts?
Because you would have been wrong with the one and you're right with the other, right? I mean, Google,
what
Apple,
would I have been wrong about with the charts?
Facebook went to $1 trillion. And it had 8 years as a private company, and so
I've used the charts for my own self to say, you know what, Bitcoin's going to appreciate over time. I've used the fundamental analysis to say, you know what, Bitcoin's going to appreciate over time, and Bitcoin does appreciate over time. I don't really think there's a problem with that. I mean, I don't understand why.
I think the problem it's not that much, but if you're throwing in 27 altcoins, you're putting.
I'm not talking about altcoins. Right? Hey, let's leave altcoins. I haven't mentioned altcoins once. I mean, I've mentioned Ethereum.
And we're still back to the fundamental issue, which is the currency collapsed 37% in the last 12 months. That's the single, probably most important macroeconomic driver, and then the technical driver.
I talk about the U.S. dollar all the time on my channel, and we talk about where it is. Like, I mean, we talk about these things. I think that you think that I only just talk about algorithmic trading. I don't talk about that at all.
Okay.
Like, literally
we can go on another subject. We've covered this one enough.
I agree.
I think I made my point. I think that people should be reasoning more from first principles, looking out over the next 5 years. And there are a lot of jarring things that happen in the technology environment. Like, it's more important that Square sells or PayPal rolls out Bitcoin to 400 million people than it is important what happened between the year 2010 to 2020.
Yeah, I agree, but it doesn't
mean... If Apple and Google roll out Bitcoin on their devices, that will be the single most important signal that we could have.
I agree. Hey, I agree. From a fundamental perspective, I completely agree. I'm just saying, hey, some people need a little bit more guidance, and to say that volatility is natural. It's been around for a long time. We're going to keep having it. It generally appreciates with time. We can agree to disagree on the importance of that, but that's one of the things I find important.
The obvious conclusion that comes from that is, since we know it's volatile, you just need to take at least a 4-year time frame, and ideally a 10-year time frame. Because if you try to take a shorter time frame, you're going to be unhappy a lot of the time.
Exactly. I completely agree with you.
What's the next thing you want to cover? Well, I want to make sure we cover all of your issues. At least we have a thorough discussion of them.
I mean, that wasn't an issue for me. You brought that one up. The models.
I know. I brought that up.
Yeah, I mean, I didn't really have anything else. My last question for you was just, what were you planning on doing for, the next 10 years? I think you gave a pretty good answer to that, and then you brought up the models. So I was just sort of defending why I use models.
Yeah.
Not to say that they're 100% right, but just to say, hey, let's just look at the data and try to become somewhat educated on what can happen. Not what will happen, but what can happen. But anyways, I do appreciate you coming on the channel. If you have if last words to summarize, or we can just call it here.
I guess my last summary is, in the Western world, we've got a devaluing currency, so you just got to find scarce assets that are going to hold their value over long periods of time. And I think everybody's entitled to figure out what their favorites are. I think that Bitcoin is going to emerge as the apex digital property, and I think that we're still early in that cycle of education. So I would say 99% of the world didn't really understand what Bitcoin was a year ago, and now I guess I would say that it's 98%. Like, I think we're double the understanding, but there's still just a lot of education. People. I think you find a lot of people can't even agree that it's digital property, or they're not quite sure about the idea of digital property, or what the definition of that is. So I think that the primary drivers are going to be the rate at which the market gets educated and the spreads. And I think the other drivers really going to be technology adoption, the big tech companies, the PayPals and the Squares, and the behavior of Apple and Google and the like. And I think there'll be, regulatory FUD, and also there's going to be clarity coming, but it won't come all at once. It'll come in every different country at a different rate with a different degree, and there'll probably be these rippling things like 2 steps forward, 1 step backwards, and the like. All of that suggests that if you're an investor in Bitcoin, you just got to suit up and wait and be ready for the jolting environment. But and I have one other point we might want to discuss, which is just views of debt. I think that by far, if the dollar collapsed at 37% against scarce assets or desirable stocks in the past 12 months, and if the average house is up 12%, and if other things like cryptos are up hundreds of percent, and if Nasdaq's up 50%, then if you can actually buy a home and pay 2.5% mortgage or 2.5% interest for the next 30 years, that's a pretty good idea, or that was a good idea 12 months ago if we look ex post facto. And if you have the ability to take out a home equity line and borrow 2%, then that's probably the cheapest, most stable money you're ever going to get. And probably if you were saving up your money waiting to buy the house and it's 25% more expensive today than it was 12 months ago, you probably you lost, right? That's not good. And in general, if you have a portfolio, if you owned Bitcoin and you sold the Bitcoin a year ago to pay off your loan, you basically sold something going up 280% to buy dollars that collapsed in value 37% in order to get paid a yield of 2.5%. You're basically loaning money to the bank. If people sometimes think that they don't want to be in debt, but if you choose not to take the loan, it's the same as giving the loan to the bank, unless you have no assets to invest, unless you're not invested. If you're invested, right, it's you're in essence selling your asset or going short to go long the dollar. So it seems that one of the most rational things anybody could do is make sure they find long duration, secure sources of financing that are cheap. And probably the cheapest money in the world I can find is people are getting mortgages at 1.5% interest on 5-year ARMs right now.
Yeah,
it's incredible.
To clarify, like I think the main problem comes, and this is not related, and it's not you, of course, but the main problem is when people, take out debt, but they don't actually have the income to cover the loan payments. Like this is what people did in 2017. Like I was around back then. There were tons of people that did this. Obviously, it's not a smart decision if you don't have the income to cover the loan, but some people do that. So assuming that everyone is financially literate, it could make sense. But that's also taking a huge assumption that's not actually true.
Yeah, I mean, I'm sure we can find examples of people that have taken on debt that they couldn't cover.
Yeah, so I just wanted to clarify that. Like, I think if you can cover it, it's one thing. But if people are taking on debt that they really can't afford, that's a completely different thing. So, like, I just wanted to clarify that.
Yeah, I think that the point that's worth making is that this last 12 months, we are in the 1 year in the last 100 years with the lowest mortgage rates and the lowest interest rates for like borrowing money from the bank, and the highest rate of inflation, the highest rate of monetary inflation, right? If we have 37% inflation and you can get a 30-year loan for 2.5%, right? That spread of interest rates at 2.5% and inflation rates north of 30%, that's unprecedented, maybe in the history of the United States, but certainly in my lifetime. And so when the inflation rate was 7% and the mortgage rates were 4%, it's like I could borrow money at 4% and invest in the S&P at 10%, and I take the risk. So you got a 6% arbitrage.
Right.
But when the S&P goes up 40% and you can borrow money at 2%, you got 38% arbitrage. And so conventional wisdom, born over the last 40 years, of be careful about debt, again, it makes sense until somebody punches a hole in the window of the airplane and the oxygen's running out, and then conventional wisdom is like, I need to act with a bit more alacrity or more aggression. I feel like right now, the risk to the average person is much more heavily weighted toward inflation than it was, right? It's like, again, it's 7% to 37%, 5 times as much inflation, right? That's the issue. The number one issue is to debate just how bad is it, and maybe the number two issue is how long is it going to stay this bad? Presumably, it's not going to be 7% a year for the next 5 years, but hopefully it won't be 30%. Maybe it'll be 15 to 20%. But we're in a new environment where it seems that the political policy is to keep interest rates low, but at the same time to create monetary expansion high. If you're actually working for a salary, that means your salary in cash is being devalued at 15, 20, 25% a year in purchasing power. It got devalued 37%. Like literally the same share of S&P stock costs 40% more today than it cost 12 months ago. So, and I know that you can't cherry pick that one date, because if you had a rolling rolling thing annualized, figure out what day of 2020 or what annual number in 2020 you want to compare against now. Let's just say that we know that the monetary inflation rate is much higher, and the spread between interest rate and then the monetary inflation rate is expanding, which means the real yields are flipping negative. In essence, paying off a loan is the same as giving a loan, which is the same as basically accepting a minus 15% real yield on the money that you had. And so this, maybe everybody's not sophisticated enough to figure it all out, but if you don't figure it out, you're the one that's getting diluted, right?
Right. Well, I mean, I think some people they have their income, they use it to pay their bills. And then maybe like if they don't have the actual income to pay the loan, that's where it becomes an issue, I think. Which, I mean, I know for you, this is common sense, right? This does not need to be said that you need to have the income to pay off the loan, right? I'm not implying that. I just want people to be careful. I just want to clarify that.
The issue there is you could basically finance the asset to pay off the loan, or sell the asset.
Well, you can
If the
sell it if it
asset went up by
appreciates.
40% in the past year, you could have sold 2% of it to pay off the loan, right?
Right, but then if it, if someone, if it drops and then they need to pay it off, then that becomes an issue. If they have to pay it off at a very specific time. So, having the freedom to hold it for 10 years, this is what you need. But if you have to pay off the loan in, say, 6 months, this would be a huge risk for people.
Well, the real problem is every government in the world is conspiring to drive up the price of assets. So I guess the question you got to ask yourself, Ben, is that if everybody on Wall Street is 40% richer doing nothing this year because of political policy, who paid them? Like, where'd the money come from? If 10% of the population is 40% richer doing nothing, then who's poor?
Clearly, the dollar is being somewhat devalued here. I mean, I'm not arguing against that by any stretch.
No, but you're still not answering the question. Think really hard. If 10% of the people holding all the assets are 40% richer, who's poor? Because it must be everybody else. And so everyone that paid off their loan or doesn't have the loan is the one that actually had the wealth stolen from them. Like, it's a zero-sum game. We have the same amount of stuff.
Yeah, I mean, I would agree that it's a zero-sum game.
Some people own 40% more of it, which means that the other people own less of it. And the ones that own less of it are the ones that have a conservative strategy, which is to go cash rich or not be in debt,
Right.
Right. So that's the dilemma here, which is, and by the way, this is the enraging dilemma. Because if you're responsible and you save your money and you don't take on debt, then you're asset poor and you've got no debt, you're asset poor, you have no liabilities, but you have no asset. And then the political system just made all the assets 40% more expensive so that you're 40% poorer, and they took it from you and they gave it to the people that took the other side of the trade. And so it's a massive wealth redistribution, and that's the real, moral hazard that we're stuck in today.
I mean, I agree that debt is, it can easily be a good thing. I just bought a house a week ago, in fact, and I have a mortgage, so I don't think it's a bad thing. I don't think that debt's a bad thing by any stretch. I don't want to imply that it is. I just think there's people just need to be smart with their money. I mean, people need to be financially literate, and if you're going to be taking on a loan to do anything with, you just got to make sure you can pay it back, regardless of what it is. Whether that thing that you're buying appreciates or depreciates in the short term, you need to make sure that that's not a problem for you. And if it's not, then it's fine. I
think probably the key thing to end this with is that, with regard to investment, the right view is you're either a saver, which means you're holding the money for 100 years, or you're an investor and you're holding the money for 10 years. A saver says, I'm going to put $1 million in Bitcoin and hold it and give it to my great-grandchildren. An investor says, I'm going to buy Apple and Amazon and Facebook and hold it for a decade, and I'm not going to look at it.
Right.
A trader and a speculator is trying to make money in a week, a month, a year, a day, a minute. And that's on the asset side. On the liability side, if someone would give you a loan for 100 years at 2% interest, you should take it.
Well,
You'll be dead before it comes due, right? It's a no-brainer. If they'll give you the loan for 30 years, you probably should also take it. If they're not going to market to market and it's long-term, then they're just giving you free money. If, on the other hand, someone is going to give you a loan that they mark to market every minute and force liquidate you, go ahead and trade on 10x leverage, force liquidated, the stock trades down or the Bitcoin or the crypto trades down 10%, you lose your life savings. Not smart.
Right.
So I think that when you think about debt financing, you should have the same view that you have with asset investment, which is you want to have a long duration, and then you want to not be marked to market. If it were to trade down 50%, you should still be willing to hold it, and you should know that your bank isn't going to call your loan. And if you have that situation, like MicroStrategy, we have debt, but none of it's marked to market. And Bitcoin could trade down 85%. It could trade down 99%. It could trade down 100%. The loans don't get called, right? And so we have patient capital that's fixed capital. The people that get themselves in trouble or struggle are people that have capital that can get withdraw. Like my limited partners will withdraw the money if I don't make money every quarter. That's why the hedge fund guys can't take risk. Right. Because if they have one down quarter or one down month, everybody withdraws their capital. And so that constrains them.
Well, and they have to fight the carry, right? And they have to be able to outperform over the next several quarters to be able to take this, the same level, the same fees and whatnot. And that's why the hedge fund lifespan is not very long, because if they have a bad quarter or two, they might just can't or close the hedge fund down and go start a new one.
Yeah. So what you want is permanent capital. And you could even say, look, I have $1 million. I'm going to put 400,000 as savings for 100 years. I'm going to put 200,000 and invest in my favorite 5 ideas, but at least for a decade. If I can't hold them a decade, they're not investments. They're speculations. I'm going to take my next chunk of money and I'm going to trade with it or speculate with it. And maybe even and the last chunk of money is entertainment and gambling. I'm just going to do it because it's fun for me to do it. I'm going to bet on random team. And if you actually divide your money into those buckets and then you're honest with yourself, then you'll probably be fine. And then on the back end, just stay away from short-term debt. Always, if you're going to take a mark to market, even if it's a loan to value 20%, there's always the risk that the thing could trade down 80% for a single minute or a single day or a week. You get a collateral call, you can't make it, you get wiped out forever. That's the problem with mark to market.
Right.
If you, on the other hand, borrowing 20% against your assets for 5 years or 10 years means that if you're 80% wrong for a decade, then you got a problem. But there's a big difference between being wrong for a decade consistently versus being wrong for a week or a day. So everybody's got to search for that. In theory, in a monetary inflating environment, if you can find a way to build up an asset portfolio of high quality assets that are not too correlated with each other, right. That's the real big issue. Are they correlated because of political risk, counterparty risk, or currency risk? If you do that and then you finance them at a very low rate on long duration, then if the money supply expands by 10% and your financing cost is 3%, you have the 7% arbitrage for sure. And if you're smart and you get the alpha and you pick the winner, then you get another 10%. And that's how you generate wealth or maintain it. And getting upside down the other way, right? Paying off everything and having no debt and then going to cash or going long cash or cash derivatives, that's puts you against the headwind, and then the world's working against you. And that would be a large portfolio of cash or fixed income stuff. And of course, the worst idea, go and invest in a country where the currency's collapsing with currency derivatives, right? Like, that's the worst idea. And most people wouldn't do that willingly, but sometimes, it does happen. The best idea is if you're in one of those countries, get out or at least get your money out. I can't move, and you can't do it with conventional instruments because you have to sit with counterparties like banks, but you could do it with Bitcoin. So if you're in Syria or you're in Lebanon or Argentina and you can buy Bitcoin, you put it at a bank in cyberspace, and at least that way you avoid the counterparty risk of the local bank. You avoid the local tax and political policy, and you avoid the local currency headwind that undermines you. Mm-hmm. Oh, well. Anything else we want to cover?
We've been going for almost 2.5 hours.
Okay.
If anyone is still watching the video at this point, I would be pleasantly surprised.
Okay.
I really do appreciate you coming on the channel. I feel like you've given us all some insight into obviously your views on Bitcoin, but given us insight into institutions and what challenges they have to get into Bitcoin and sort of the timeline there, which I think a lot of people are interested in. And yeah, I really appreciate this discussion. Thank you for coming on. You're always welcome to come talk about Bitcoin and Ethereum if you want on the channel. And yeah, thanks for coming. And I will see you guys next time.
Great. Thanks for having me.